There's a tremendous amount of profit potential involved with trading the S&P market, but at the same time, the risk involved with trading futures is extraordinarily high. I started trading in 1982, and it has always been my objective to harness the risk associated with this risky environment. You can identify what the risk is and place your stops according to your technical analysis, but it does not remove the risk. Moving from futures to options has allowed me to reduce the risk effectively. And in today's market with the weekly options, I can trade this market at a fraction of the cost and at a fraction of the risk. My risk to reward has increased dramatically, and I've put together a program to demonstrate how I prepare each day and how I execute my trades each day. Here's an example of what we did just this past week. Okay, so here we are trading Monday morning, September the 16th. We started out making our way down very early in the session from resistance at 1708. Made a retracement about up where we would expect if this was going to continue to the downside. Put in a reversal bar. I measured some sell programs coming into the market, and we issued and we bought puts here for $3, the 1685s. The objective for the trade was to come down here to 1690 to 1688. At that point, we would expect the value of these options to be $6, a doubling within a day. We stalled later on in the day, and the market was very slow during these trading sessions. They were so consumed about what the Fed was going to do on Wednesday. And so we had about $1.50 profit in here, and we took it. But what I wanted was this area down here. The following day on Tuesday, we very slowly did hardly anything. We just kind of moseyed up here. And then on Wednesday, we continued back up into resistance at 1708. I issued and we placed the same type of trade as we did previous, buying the puts again at about the same price, an average of $3. The market started to make its way down here in almost a mirror image. This is about the area that we would expect to retrace to. So at this point, there's a couple of things that could happen. One, we continue downward all the way back down to support, or this could be the start of an uptrend where we retrace down in here to support, and then we pivot here and go upward from there, going through resistance at that point. The way that I am able to consistently pull profits from these markets is to look for possibilities and place myself in a position such that either way that it happens, I could generate a profit. So what we did here at this point is that we had about another $1.50 of profit here. I cashed out half the position and I invested in calls, the 1715, creating a strangle here. And this was Wednesday morning, just before the Fed was to announce its decision. So there was a lot of uncertainty that this market was waiting on. The Fed made their announcement, and this market came unglued to the upside. As per our trading plan, we always have areas labeled on the chart above and below the market, representing potential areas of resistance and support. And this market very quickly made its way up into this area, 1734. Now, back here before it happened, we calculated the value of what we would expect these options to be worth if we reach this potential target at 1734. And at this volatility before the market came unglued, we expected the value of those options to be worth about $16. The nice thing about options, when you're long the options and volatility comes into the market, vega increases dramatically. And so we were able to sell our position here at a price that was overvalued the theoretical value that we measured initially. And so before the market reached its objective, we were able to reach our profit objective for the option, getting out before the end of the close of the day. These levels represent an excellent target to have in place beforehand. These puts, they're not going to be worth very much. The calls, they went from $4 to $16. Having these levels in place enabled me to position myself in such a way that I can pull some income out of the market while I create these positions for growth. So if you go to our website, esoptions.com, and look under video archives, I have about 2 weeks worth of trade information. It basically summarizes what we've done in the market for the last 2 weeks. Now, the way in which I teach our trading methodology in our subscription service is that each day before the open, I create a trading plan for the day. It's a very short video in which I define what the support and the resistance areas are for the day. During the course of the day, I send out real-time trade alerts by way of Twitter, and I oftentimes attach a picture so that when you receive it, you have a clear-cut idea as to what we're planning to do or what we're doing. I send out both tweets during the course of the day. We also have a real-time broadcast room, which you have complete access to. And in this room, which is powered by GoToMeeting, we post our charts in real time and the notes, and we show the execution of our trades in real time as they happen. Now, I know in looking at this video, these levels look suspiciously accurate. Anyone can draw horizontal lines after the fact. It is very reasonable to doubt this. So what we do is we offer a 3-day trial. At no cost nor at any obligation, you can receive our daily trading plan, look at our charts in real time, receive our tweets throughout the course of the day, and prove to yourself that there is value in knowing where these levels are and see in real time how these markets behave at these levels. After 3 days, you're probably still not going to believe what you're seeing, but I have a feeling that you're going to want to know where these levels are moving forward. If you have any questions about anything that you've seen in this video, you're welcome to contact us. I prefer by email, for it's easier for me to keep up with. But if your typing is as bad as mine and you'd like to call, you're welcome to do so. If I can't talk to you, I'll call you back. Thanks for watching.